Hello, welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20 minutes, we'll talk about a very important aspect of mutual funds. In fact, I call it very important also because there's so many people who've written to us about what should they do with regards to this particular aspect. And that aspect is then the markets are buoyant. And more importantly, when people are talking about how the decade might be belonging to their country, and in this case, our country, which is India, can they build a portfolio, a mutual fund portfolio, which can last that whole time period? Because not everybody has the time to look at the portfolios every single day. So we tell everybody that if you don't have the time, it's best to approach even this aspect through an advisor who can keep on hand holding you through the journey. But for DRI investors who might want a long-term portfolio, is that an option in a market which is so dynamic? Well, let me not try and answer that and ask this question to two experts who probably do this for a living day in, day out. Shalini Sekhri, she's CEO of Infinity Asset Advisors, and Himanshu Kohli, co-founder of Client Associates, join us right now on the show. Both of you, thank you so much for taking the time out. And I guess that it won't come as a surprise, this topic, because you must be getting this question asked too. Shalini, I'll start with you. Is this something that is top of mind of clients? Build out a portfolio for the long term.
Yes, absolutely. We are, I think, in a time where every day is a new historic high. And I think we're speaking on that very special day, as we were just discussing before this call started. We would all love to be long-term investors. Every client we speak to say they do want to be long-term investors. But I would actually like to start by asking myself and everyone on this panel that do we think it is possible to buy and forget your investments for 10 years? And I think that's where really perhaps the views of both of us will come in today. Now, while I do believe that every investor will have a different asset allocation, it will depend on age, lifestyle, current financial health, goals, risk appetite. It would be very simple for an advisor to say that, okay, for a conservative investor, let's do say 30% equity, 60% debt, 10% in gold, fill it, shut it, and forget it, or maybe just keep adding passively to SIP. Or similarly, for an aggressive investor, that should be do 70% equity, 25% fixed income, 5% in gold. Let's forget about it. Honestly, Neeraj, unfortunately, I think the answer is more complex and individualistic than that. And I believe we really have no choice but to take a goal-based approach, not just one that is goal-based, but which requires a regular review. And I think that's where really, structured financial planning comes in, discipline comes in, looking at your portfolio and your goals come in on a regular basis. And honestly, if the plan is right, then the yardstick really to measure the success, I believe, is not whether the investment outperforms its benchmark, but rather how well it is able to help the investor meet their personal goals. And that, to my mind, is truly a successful investment plan. That, unfortunately, requires some discipline and some work.
Yeah, well, some discipline, some work. Not everything can be done on this show. So I'll try and do what I can do best on the show, and try and understand that if somebody were still to do it, how do they go about doing it in which is the best possible shape? Let's put it this way, Shalini, or as the lesser of the two evils, if you will. But Himanshu, let me get you in on this conversation first. To your mind, and your answer could be completely different. But is it possible for somebody who wants this as a goal that bhai, mujhe banana hai, I want to make a portfolio which can last me for the next 6-7 years? Is it possible to do it?
So I would agree with Shalini. What she mentioned, the discipline. Neeraj, there are 4 things which impact the success of any investor. What should be my strategic asset allocation, market timing, product selection, and luck. These are the 4 things which impact the success of any investor. As per various studies which have happened, empirical data on developed markets, developing markets, 91% success comes if your strategic asset allocation is correct. Market timing, product selection, luck contributes less than 10% towards the success of an investor. Unfortunate part is most of the investors in India, globally, they just keep on spending their energies, time on when to enter, when to exit, which product to buy, and hope luck to support them. And they forget the big picture on what should be their strategic asset allocation. So what happens through strategic asset allocation is the point which Shalini was mentioning. It brings in a huge amount of discipline. And that is something where experts like us comes into picture because people just talk about returns, but there's an other R, which is the risk part of it. And most important, the correlation or behavior of one asset class versus the other asset class, one index versus the other index, one markets versus the other markets. So that is something which is, we believe there is a lot of science which goes behind construction of the portfolio basis the profile. And I believe, let's say a median age profile, 35, 40 years, if they have a really, let's say 85, 90 years of lifespan, if they just preserve and grow at 7%, 1 rupee or 1 crore can be 30 crore rupees if they compound it at 7%, which is conservative. But if they get into a moderate profile, which is combination of different asset classes, same period, 50 years, 35 years old, invest with the 50 years kind of a time horizon, it can be 300 crores. And if they get into very aggressive mode, which is getting into businesses, unlisted businesses, and compounds it at 16, 17%, it could be 3,000 crores. But what determines whether one should be conservative, moderate, or aggressive? It's actually the financial plan which needs to be drawn. What is the need-based wealth? What is the surplus wealth, which is for the next generation? So this is something which we get into and come up with a plan over there.
Got it. Now, viewers, standard disclaimer, we'll talk about mutual funds on this show. And lest you get too excited about making that 1 crore, 3,000 crores by use of private businesses or private investments, it's a very difficult task. That is exactly the opposite of what we'll try and do on this show today, which is try and understand the ideal mix in a passively owned or passively held mutual fund portfolio. But yes, I think the numbers that Himanshu spoke about, they might well be true if you're able to strategically choose the right kind of investments. As is the want of this show, we'll talk about funds. So Himanshu, I'll come back to you. I just want to understand that we're trying to cater to the viewer who is wanting only mutual funds and not other things in the portfolio, or the larger part of this thing is the mutual funds, right? So if somebody wanted to build out something, it could be reviewed periodically. The person should ideally have an advisor who can handhold and change the dynamics of the portfolio at various points of time over the next 7-year cycle as well. But let's say somebody wants to know what should an ideal mix of the portfolio at this point of time be if the person is designing a portfolio meant for the next 7 years. What would you say? MF portfolio.
Sorry?
Mutual fund portfolio.
Mutual fund portfolio. So let's say there is a moderate profile of the investor.
Yes.
Moderate profile could focus on maybe 60% growth, 40% preservation, or 70% growth, 30% preservation if it's moderate plus. Now, basis that, one can then get into a combination of not only debt and equity, but certain other asset classes also. So let's say debt alternatives could be another, equity alternatives could be another one, hybrid could be another one, gold could be another one. So basis combining these asset classes, basis the profile, one can actually create a portfolio. So there could be two approaches. One is I will just get into balanced funds with the 7 years view, and I'll get maybe double-digit, low double-digit returns from my portfolio. But there could be volatility in between. But other better approach could be where I see the correlation between one asset class and other asset class, maybe bringing in 20% gold, maybe bringing in 20% fixed income, maybe bringing in 40% equities, and maybe bringing 20% towards alternate asset classes. That can also give me a double-digit returns with a far lower volatility. So investor could look at combination like this, or someone who is getting into a regular saving, systematic investment plan into mutual funds, depending on the risk profile. So equity could be one which is a preferred choice. But if someone doesn't want volatility, too much volatility, which bothers them, then maybe one can get into a combination of equity plus BAF kind of strategies, balanced advantage funds, and systematically build the portfolio.
Okay. Sorry, just one follow-up before I go to Shalini. Himanshu, are you saying that you would be comfortable if you were this person who's between 30 and 40, moderate risk profile, 30 years of earnings lifespan in front of you, would you build out a 7-year portfolio with only equity funds?
If it's systematic,
yes.
I'm very comfortable. If it's systematic, I'm very comfortable building it through a systematic investments into equity mutual funds. But if it's lump sum investments, then I would like to have a portfolio allocation approach, which is what I mentioned, combination of equities, combination of hybrids, combination of fixed income, debt alternatives, equity alternatives. That is how I would like to build up, with maybe 10% of gold also on top of it.
Got it. Thanks for that clarification. Now, Shalini, the same question to you. I heard you at the onset that it's virtually impossible to do that to your mind. I'm still putting a gun to your head and I'm telling you, here's a client. She's listening to the show right now. She's wanting to build out something like this. If you were to design it today, what would your advice be?
So at the outset, Neeraj, I'd just like to highlight that, if you look at the last 10, 11 years of our various asset class return profile, every year has actually thrown up a different top performer. 2022, which was not short of excitement by any standard. I'm sure a lot of viewers would be very surprised to hear that gold, which we just think of the safe hedge part of the portfolio, was actually the best performing asset class with a 14% return. And equity just gave 4%, fixed income gave you 3%. So to your question on whether should one build a completely equity portfolio, well, obviously in the long term, the numbers are very clear that it gives good risk-adjusted return. The fact remains is that I strongly believe that asset allocation will be very important. Every bucket would be required because there's just absolutely no telling in Russian roulette, as we seem to see in our markets, which asset class will be top of the heap. So I do believe that mutual funds do have a very wide spectrum of strategies. It will easily enable a client to be able to build out a well-diversified portfolio in line with, wanting to be a long-term investor and also meeting his life goals. And you can see that you have mutual funds across different asset classes, so equity, debt, hybrid. You can match your investment goal by doing a growth or an income or a tax-saving fund or a fixed maturity fund. You can look at a style, right? So now there's this huge discussion on that. Do we look at active mutual funds versus passive? On the active side, what I would like to point out is that, as per my analysis, almost 90% of large cap mutual fund managers have underperformed their benchmark on a 1, 3, and 5 year perspective. What that means is perhaps, at least for the large cap equity fund category, there is a very strong case to look at perhaps passive funds, which are the index and the ETF equity fund category. So if I were to just quickly jump ahead, what do I think we can advise an investor like the type that you suggested, a moderate investor looking for, a regular, steady kind of a portfolio with risk minimized? I would say that a client like this should look at, say, debt at about 40%, equity maybe 30%, balanced and hybrid, which gives you a combination of equity and debt about 20%, and maybe gold at around 10%. Within equity itself, one can think of, maybe large cap index funds as opposed to active funds at maybe 30%, multi-cap funds around 40, 50%, and the rest in mid and small cap. I believe this would dull in volatility and would still deliver good, inflation-beating returns to an investor, keeping their blood pressure low and enabling them to see some return in their portfolio on year on year. So that's really my perspective.
Shalini, a question that might come in, and I'll of course follow that up with the question to Himanshu in the same, is because diversification is so important, and there are fund managers and mutual fund CEOs who are coming and talking about the benefits of having a multi-asset fund over a longer period of time, wherein the client is not, necessarily needing to take any kind of calls on when to move from one asset to the other because the fund manager does the job. How important would that be for a long-term portfolio?
So I would think that to some extent is completely leaving it, to the fund manager in a way that it might not exactly match what should be your asset allocation. We're also seeing a situation where, in order to make it tax efficient, we're seeing a fairly large percentage that's going into equity, right, to be able to give it the equity taxation benefit. And as a result, perhaps the percentage to something like a gold, which might merit a larger allocation for certain kinds of investors, can be quite small. So our view is that in years where, say, for example, 2022, it's gold that's hitting it out of the park. Does it make sense to kind of be constrained by some of these? So while I do know there are one or two fund managers where the constraints are not that much, I would say in general as a category, I believe that even with a little bit of help and advice and even one's own research, a client will be able to create a more suitable, tailored asset allocation for themselves. That's what I would do if I was the investor.
Himanshu, the same point to you as well. Multi-asset funds and their presence, because both of you have spoken about how to allocate differently. If a person is confused and not wanting or not able to do that, still wants to be a DIY investor, would multi-asset funds be an answer or not quite?
So I would say someone who doesn't have the luxury of appointing a wealth manager or hiring a wealth manager, multi-asset fund actually works out very well for them. And reason is sometimes we do not get the time to look at the portfolio. Sometimes there is an inertia. Sometimes there is a cost angle which comes into picture, whether it is taxation, whether it is entry, exit, loads, all those things. So multi-asset actually works out fairly well. And also, Neeraj, if you see hybrid funds, which have just followed maybe 2/3 equities and 1/3 fixed income, historically, they have not only reduced the standard deviation, but they've also created half to 1% alpha compared to a static portfolio of 2/3 equities and 1/3 debt. So I would say someone who cannot rebalance, someone who does not have the luxury, can actually look at a multi-asset portfolios. Someone who has, they then can actively manage it along with the wealth manager and look at those options.
Got it. Shalini, just one last question on this to you. And I think Himanshu made an important point that he's comfortable for an SIP investor over the longer term to have a pure equity portfolio. Now, history shows us that over 7 years, the volatility evens out and the returns on equity portfolios in India at least have far outstripped anything else. For even a risk-averse investor, could that be an option? Because typically people will say, hey, if you're risk-averse, maybe put in other asset classes. But history shows that equity funds over a long period have given tremendous returns while being equitable on risk, so to say, even if not in spirit on paper, but in reality.
So I absolutely agree with both Himanshu and you, Neeraj, that for a long-term investment.
No, please continue.
So what I was saying was that I believe that averaging out through SIP, as Himanshu pointed out, is a wonderful tool to take advantage of the ups and downs in the market. The other real risk mitigant, if risk can have a mitigant, then why not? I think one can certainly look at equity, and I think the best risk mitigant is time. And there's enough analysis all around to show that, in general, if you look at a 5-year holding period, there are almost no periods where a client who's had a 5-year horizon has actually walked away with negative returns from equity. So I would say risk, if it can be mitigated by staying invested for longer periods, is certainly a great way to go and enjoy the returns that do come with equity as an asset class.
Fair point. Final question, and I'm just moving on topics now because this is the other thing. So actually on this, both of you, thank you so much for giving us some very valid details and some good data around the portfolio construction as well. For everybody who's listening into this, this may be a good way to construct a portfolio. For individual funds, I think because individual funds would vary depending on your risk appetite, it's best to have a financial advisor who can give you the advice on the same. So, urge you to do that. Now, so many of you have written to us about healthcare funds as well. Let me try and see if that is something that our guests can give us some insight on as well. Himanshu, I'll start with you on this. And I believe you don't normally advocate sectoral or thematic funds. Still wondering if you have a view on healthcare funds, because the sector is coming of age. A lot of people on the equity side are talking about getting into that bucket, and a lot of people have queries about what kind of healthcare funds to get into.
So, Neeraj, it's very important to follow a core and a satellite approach while you're also selecting your mutual funds portfolio. So let's take a simple equity asset class, 20% large caps, 40% multi-caps, 30% mid and small caps, and 10% could be a sectoral fund or a contrarian fund, which could be come into picture. I have seen sometimes a sectoral fund, because the fund manager has to pick up 30, 40 stocks because of diversification. Even if there are 8 to 10 stocks which are very good, balance 30 comes more like a baggage over there. And the risk return matrix doesn't justify. So maybe taking a 10% kind of a contrarian view, which could be heavy on a healthcare side, could be a good approach. because last 3 years, if you see, benchmark index has compounded by 25%, while healthcare index has compounded by 16.5%. So if life averages has to hold good, maybe healthcare will also do catch up in the next 3 years or 4 years. And if someone is entering with that kind of a time horizon, it makes sense to be slightly overweight compared to what the index of healthcare is. So there I would say maybe getting into a contrarian fund, which has reasonably higher exposure, or an opportunist fund which has a higher exposure towards healthcare, could be a good option. But if one doesn't want to apply too much mind on this, maybe then taking up a simple healthcare fund like SBI is a fairly stable, seasoned, has given one of the best highest returns per unit of risk over a period of time, could be looked at as a fund within healthcare. So I would not recommend going for a pure sectoral fund because of the challenges which I mentioned over there. But if someone still wants to get over there, better is to go through a contrarian strategy. If not, then maybe just selecting one of the most stable options, only to a smaller extent, which is a satellite, not the core portfolio of theirs.
Okay, very valid points. Thanks, Himanshu, for that. Shalini, the same question to you. Healthcare.
Right. So I think there's no arguing that with COVID-19, that's been a sector that's, front and forward. Last few weeks have been flooded with news flows, such as, say, large insurance companies are buying healthcare stocks. Foreigners are buying a lot of healthcare stocks in India. And as a result, clearly we are seeing, some tailwinds here. In fact, I was looking at the 1 year, 3 year returns for some of the best performing funds. All are a stellar, 20% plus, even on a 1 year basis, if I look at the top quartile. You'll still be surprised to know that this by no means is, one of the best performing sectoral funds or sectors, right? So there are many more which have done far better than this. So I think therein lies the rub, that in India, where you see so much sector rotation every year, where every year is throwing up very different winners and losers, and the divergence between the worst performing and the best performing sectoral fund is huge. It's quite hard, I would think, for a layperson to be able to take the relevant call. That having been said, I think intuitively we all understand that healthcare, which today is not just pharma, but a lot more sectors such as hospitals, etc., certainly have structural tailwinds, and I think one will make decent returns there. And you could look at a small allocation in, as Himanshu said, the SBI one, or perhaps DSP has a good stable portfolio, Mirae, Asset Healthcare. So there are these 3 or 4 larger stable funds which are doing well. But again, to point out, these are certainly not the best performing sectoral funds when I throw in all the other sectoral funds other than healthcare as well that exist today.
Just that the number of queries on healthcare funds are so high, it was important to bring that up in today's show.
Certainly.
But Shalini, Himanshu, it's been a pleasure talking to both of you. Thank you for taking the time out and giving us your thoughts on the Mutual Fund Show.
Thanks for having us. Bye.
Thank you
Pleasure
so
is
much.
entirely ours.
Thank you.
And viewers, thanks for tuning into yet another episode of the Mutual Fund Show.